Be on there. All right, here we are. Perfect. So this is the case study here, ladies and gentlemen, about what's happening with our Class A industrial deal. For those of you who don't know me, I am Salvatore Buscemi. I've run several different entities, investment entities, where we're principal investors in a lot of deals. And I started my career at Goldman Sachs, and right now, with my partner Albert Yu and CFA, I co-run Brahmin Partners, which is a private multifamily investment office with roots in New York and Boston. The name Brahmin Partners means high priesthood in East Indian culture, but it was primarily a nod to the investors and CEOs who we know in Boston, the Boston Brahmins. It's an interesting story of influence and thought leadership, and insight, which has built the country. We only allocate into high conviction opportunities, life sciences, deep tech. That comes from my partner's background in life sciences, and also Class A real estate, which we're talking about here. We back operators, not opportunists. We're not tuition. We're not Shark Tank. For us to get into anything, I want to see that there's a lot of depth with the founders having a lot of exits coming out of deals, meaning that they were involved in, not that they happened to be maybe an employee at a company that went somewhere. We want founders who are very experienced and who can go through these opportunities. Um, and we go through these opportunities really just looking at the end game. Is this guy and girl going to be able to get us out of this deal at some point? What does that really look like? We make private direct investments, and we don't chase deals floating around on LinkedIn either. Because of our reputation, we were asked to participate in deals. And some of the events that we have, some liquidity events where first quarter last year, Sing Life was purchased by Sumitomo Life, so that gave us a good multiple on invested capital. We've done 6 allocations into SpaceX. Stripe, we've done 3. Thrive Bioscience is one of our darlings. And one of our companies, AI.io, just received um, $50 million from the Sovereign Wealth Commitment, which is a really great way to end the year. So that's really encouraging. And I encourage you guys to follow me on LinkedIn as I continue to go through these deals, and you can see what it looks like. So the investment philosophy that we're looking at here is that we are long-term allocators. We're not operators. We're allocators. We just want to put capital into something. Some people, depending on the families or what we're working with, they can either be long-term investors or short-term investors. This one deal that we're talking about here is not long-term. It is something where it's our first deal with this operator. We really love working with them. And we follow the same, profile of this for the longer term investments, sort of like the Zara family. Amancio Ortega, he owns a lot of industrial, he owns a lot of Class A real estate that he pays for cash. If you know his family office, Ponte Verge, Intenex is his company. I think that's the holding company for everything. But if you see anyone wearing a Zara bag, all the proceeds from that sale usually goes towards Class A real estate in different countries, actually. And then also the LDS Church, which I consider to be the best run family office in the world. They're also allocating into these Class A industrial facilities. So we follow 3 rules before we allocate. Before I even get anywhere, is no first time GPs. We don't like working with first time GPs. It's kind of obvious they come out when interest rates are low. People didn't really in the last cycle. People who look like they couldn't even do any bond math were buying properties sight unseen, apartment complexes all over the country, doing some light, what they call value added, but really they were putting lipstick on stuff. And then they wondered why they couldn't get out of the deal, or they had all their investors lost all their equity, is because they didn't really know what they were doing. And so that's why we stay away from them. I want them to have gone through at least 2 down cycles. This one hasn't started or ended yet. 2008 was one, and then I want them going back to the 90s, after the savings and loans crisis. That's how if there's gray hair in the deal, we like that. Meaningful co-investment. 5% is cute, 10% is thoughtful. Anything more shows complete conviction. In our last deal, the family put in a tremendous amount of equity into the deal, and everybody was happy with that. So, I always tell this to people who we work with, and we have about 13 families and a bunch of people who are not families. I determine a family economically to have at least $100 million in investable assets. And we always say that our own capital's in the hat alongside yours, and that's never changing. And really, what my partner and I do is we see an opportunity, it usually has a fuse on it, and we just pass the hat around to see who else after we put our money in. Cool. This deal we're getting into is the first one in 5 deals in Melissa. And I don't know if any of you have known this, but this is actually a YouTube video of me in our last development in Las Vegas, which is amazing. And I gave an interview to beloved Southern California podcaster Oliver, who came in, Oliver Graff from San Diego, and it has, I think, about 122,000 views right now. It's really a masterclass in raising capital. It's sort of how we've gotten to the point where we are today. Going into this deal, a lot of people wanted to see what we were doing, looking over our shoulders as we fund these deals. Okay, the performance has been absolutely amazing, but this is the type of product that we like going into, and that means a lot to us as well. All right, so let's talk about something here which I think is kind of interesting, and I would want to know if you guys can hear me or something. I see you. All right, Osama, thank you. All right, I'm just going to open it up so it's easier for me to read. Um, we had an origin story, I'll tell you. So we had an exit in 2024, and a lot of people were holding on to those proceeds, but they were waiting to get into a real estate deal. They know that we love real estate. We love Class A real estate. That's sort of my passion here. And I actually have a bonus for all of you at the end of this as a measure of thanks for sticking along with me here. So after a string of exits, not just with us, but with other people, many smaller investors here waste newly realized wealth. What does that mean? They chase the shiny deals. They follow influencers who are great marketers but have no experience or depth as operators. And they get seduced by multifamily operators who don't follow the underwriting rules. It's amazing. When people start asking me something and it's a surefire sign of their sophistication is, they think that achieving the highest return possible is a symbol of success and status. And I can tell you there's nothing like that. There are people who are offering all sorts of fancy IRRs that are made up, but if that's what you're going to use to lead your investment or numbers that you don't understand, that's an entirely different thing. I remember when I first left Goldman, I was talking to a pension fund manager trying to raise money for my first fund. And one of the guys told me, he said, Sal, my beneficiaries can't eat IRR. They can't eat IRR. So, that's really the most important thing here. I wrote about this in my book, Investing Legacy. People will rarely tell you where the money went, but if you look at their avatar, their 5 investing archetypes, you can usually tell where it went. If not, then you run into somebody's spouse at the airport, and she will tell you that it went into Bitcoin. This happened in 2015 with other opportunities we were working on. So we source this deal the opposite way. People come to you, and a lot of people don't understand, but finance is all about trust. Right? Finance is about trust. Let's just say that people have a lot more trust putting their money with JP Morgan than they would in a smaller foreign bank somewhere else, right? And the reason is because those decades-long relationships and building a brand is very important to a lot of people. And it's the same thing with us too as well. I made a few phone calls to people that I've known for a while, and I said, look, I'm in need. We have some families here that are sitting on some cash. I don't feel like it's going to go into anything wrong, but they're tempted, and everybody's they're getting pitched deals all the time too, not just by me, but from somebody else. I'm thankful that they take my calls though, which is amazing. We sourced it because I want operators, because it's my own money going into this, but more so than that, it's my reputation on the line here, that a lot of people just waste away coming out of the gates because they're trying to do something aggressive, and that never really works. We like it because the land was already owned, and it's also a first mover advantage to an America's fastest growing corridor, which is between Dallas and Oklahoma. All right, cool. All right, so here's what we did. We put together a Zoom. We told the story as who's Creed, how long do we know these people, why shallow bay industrial is the single smartest asset class for this part of the cycle. And then we followed up with an email to ask for the term sheet. If they liked what they saw, they got data room access. If they understood the deal, then that's capital. That's a capital conversation that we continue on with that. Of course, being sure not to violate any SEC rules or anything like that. We just understand that this is the way it works, and the expectations are there. A lot of new people who are raising funds, you got to think about it this way. The second rule of real estate is to always be raising capital. If that's something that you are not accustomed to working with or learning how to do, this business is not for you. Banks are not always going to be there willingly lending money out, especially in difficult times, and that's where a lot of problems happen at this point. But this discipline sequence, it screens out the unserious, but it brings forward the prepared. What it also does implicitly is that it defines the boundaries of the relationship. That yes, you asked for this, I'm going to be hounding you for this, okay? Like this is, we have a clock to our heads. We have our reputation on the line. I'm trusting you with my reputation because, as I'll talk about a little later in this presentation, and I don't think it'll go longer than another probably like 15 minutes, is that capital is a commodity today. There's people buying houses and things that I never thought, and I think with Doge and Elon Musk, we saw that there was a tremendous amount of people who got wealthy very, very quickly after the pandemic. And that's going to happen when you put 200 years of federal credit on the balance sheet in just 18 months, as we saw during the pandemic. So, who this deal is not for? All right. Um, Other real estate investors are not going to be your LPs in this deal. It just they instantly disqualify themselves. Not that I don't want them in their deal, and we have one who's in the deal, but that's only because he loves the family that we're working with. But for the most part, a lot of these guys can source their own deals because in real estate, there's two different types of people that use real estate. We're one. We're the allocators. We're not the operators. We're not finding the deals. I mean, we're finding the opportunities to fund into, but we're not going to be doing the heavy work dealing with GCs and all of that. We don't do what professional value-added real estate operators do. Is that they buy fee. They buy the building at a discount. Maybe they buy a note. They foreclose with it, and they move forward. I like investing in those deals too if I'm not doing the work, and that's some of the stuff that we'll be working on. There's an ego there too. It's like, well, my deal is always going to be better than yours, right? So it's going to be very hard for a guy to admit, and a lot of you guys starting out have probably seen this, that they prefer to control every decision. They want to be involved. They don't. And some of these guys, if you look deep down, they I don't know why they want to do that, other than they just hate their family. Like, why would you want to control every decision unless you're investing the full equity amount? Why would that matter, right? Then there's other people that we were introduced to, and it's like the jilted ex-lover, and it's sort of like and we're having our Basel appreciation dinner, and one of our investors wanted to bring someone, but they got screwed hard on a multifamily syndication. Okay, and I can tell you that these are not the investors you want to have, and I can tell you from personal experience. My second fund when I was out west, it was called OFRE, and it stood for Oasis Fractionalized Real Estate Equity Fund. And we were buying, basically, we bought a servicer for $1 and we capitalized it with 20 million. And that 20 million meant that we were going after investors in these, let's just say, busted real estate syndications. And when you talk to these people, and we were buying the debt, right? So we needed to get 51% of the debt, then we would foreclose on the rest and then cleanse the asset and sell it off to a REIT. And it worked. However, when you start dealing with these people, you needed a way to deal with them. And what I learned is that there's a lot of angry and apathetic people who you don't want to deal with. They're always going to be, they're always projecting old wounds on the new operators, sort of like if someone comes out of a relationship and they have trust issues, and they're going to have trust issues with you here because, let's face it, raising capital is just like dating. Nobody likes to admit it, but it's absolutely true. And people are going to look at you and treat you in the same way. We don't want any of these people. They're like, how do I know you're not going to screw me? Well, how do I know you're going to write a check? How do I know you're not going to annoy me? Well, we have a track record here, and here's references you can talk to. But at that point, as soon as they say something like that, they automatically disqualify themselves, and I quietly remove them from our newsletter that we send out, discussing our deals and inviting people in the Zoom. I do not want people who have been wronged by somebody else, and then I have to come in as a knight in shining armor. Anything can go wrong. We make sure that we structure the risk away from us and our investors to the best of our abilities, and that's really why we're professional investors in the case. However, stay away from these people because they're distrustful, they're cynical, they're angry, they're not going to help you. And if you're bringing on an investor who you don't want to hear from on a Monday morning, do not bring them on. Okay. And then there's the small spray and pay investors. They want to get rich quick, but they don't want to pay any fees. Okay. They don't understand it. They feel entitled. I can tell you, fee structure we use for our deals makes it asymmetric for the whales to help us scale the investment in every deal that we do, because we have a flat rate fee, and we'll talk about that a little bit later. They don't understand illiquidity. They'll be like, I thought I would get out of this. I could get my money back. No, it's in real estate. Oh, okay. No, stay away from these people. If they don't know anything more and they have a financial advisor that tells them to stay in stocks, they're not for you. They have no control and no discretion, which we'll get into in a moment. Okay. And they should stay in funds. A lot of these funds are liquid, illiquid. They have different features, but for the most part, they're never going to get direct access to something. They're going to be in Apollo Real Estate Capital Partners Fund 9, which is going into 10 months of its 10 years of its 7-year term. And when you're raising capital, you want to make sure you don't marry someone who's still dealing with their exes, and that's the same thing with LPs as well. You don't want them to project that onto you. Okay. Who this deal was for? Well, I mean, this is for people who have operating companies that are throwing off cash, and real estate is nothing more than a glorified tax efficiency scheme. Really, it is. And we had to structure certain things for different people, and I'll get into that in a moment. But Sal's rules: the cap table is the soul of the asset, and I am working with several big people here, bigger than me. I know you guys think I'm big and great and everything. But in the real world, I got people overlooking my shoulder too as well, and that's part of the partnership that we have with these people, and they want to make sure that they're not paying or subsidizing the freight and voyage for their investment for the smaller suckerfish and guppies across the duration of the investment, because it takes money in the form of fees to handle this. Raising money and managing money is no different than having a yacht. And you have to put away at least probably 10, maybe even more, 15% of the yacht's value per year to be able to maintain it. Here, it's not nearly as expensive, but if you don't do that, you're going to run into problems. And they just want to make sure. And smart investors will ask you, well, how are you keeping the lights on? You're going to wait all the way until the end before you're going to go dry, for 3 years before this comes up. That never works. And a lot of people have gone broke waiting for that to happen. But I did write something about this in the LinkedIn articles a little while back, and it was kind of controversial at the time. But people really understand it now. You just got to treat your bigger investors better than your small investors. That doesn't mean you ignore them, but you have to make sure that they're incentivized to put in as much as possible. Whereas, regardless of the investment that somebody puts in, they're paying their fair share, and that's really what it comes down to. Because if anybody sees this, I don't want to be embarrassed to show them that I have a bunch of smaller, which we don't, but $50,000-$25,000 investors who can't afford to pay fees, but they want to be in the deal. This is not for them. This is not for them. So we had to prove to our investors the trust, which is, look, it's all you can eat. If you put in 100 grand, that's fine. If you put in $1 million in this deal, you're probably going to make about 74 basis points higher on a cash on cash return. So it becomes de minimis, the upfront organizational fee that we use to do this. So this is for families with operating businesses. Great example. A lot of Utah families that I know own a lot of franchises, a lot of food franchises. And so they have a lot of cash flow that's coming off, free cash flow. And what do we do with it? Well, here's what you do. You put it into real estate. Same thing as Zara, okay? Same as Zara. But they're not that big. They're not over $1 billion. We're at the point where you have your own development arm, if you wanted that. But they don't have that ability to do that, to start their own development arm. Or merchant builder, which is a difficult business in and of itself. There's also families too who are the nouveau riche, who had exits over the past 5 years. They had a liquidity event. They were invested in something. There was a PE event, or maybe it was a VC. And us, it was VC for us. And they want stable, reputable, but asymmetric opportunities, not more risks. Not more risk. What do I mean by that? Most people read risk like a wine list: over to the right and down to the bottom. If you're on a date and you're trying to impress someone, over to the right, down to the bottom. So the $2,000 bottle of wine is supposed to be much more delicious, therefore it's much more exclusive. And people look at that with returns, but they don't really understand risk. And the risk here in this deal is somebody who was telling me, well, not this deal, but a deal beforehand that we had in Las Vegas. And he said, well, you're going to give me X, and my brother-in-law, who is doing, value-added. He didn't understand it. He was a doctor. My brother-in-law, who's doing value-added in Cincinnati from a Class C to a Class B, and he's never done this before, is promising me double. And I said, okay, we're going to talk about experience. So there's 2 ways that you handle it. Number one, if you had to have open heart surgery, do you want someone who just graduated from medical school in Grenada, who's going to give you a free toaster to perform the surgery, or do you want someone who's done it at least 5,000 times? That's what we're looking for here. And the other start of it too, as well, do you really want tenants poorer than you when it comes to your life savings? I mean, can you really look at your wife and kids in the eye and say, yes, we invested into Class C multifamily, hopefully it'll be Class B, with tenants who are poorer than we are? That's not anything I could go to sleep at night thinking about, because it just scares me, especially with a lot of the families that we knew in New York during the pandemic, who got absolutely wiped out during the pandemic because they changed basically the tenancy laws to become a lot more pro-tenant, and that abused a lot, and that actually caused in my estimation, the failure of Signature Bank. Okay, sophisticated newer family offices, they all have, and I talk about this, an impact statement. We help them do that in their book. In my book, we ask them to put that together. They want to come on. I want to see that you have a clear legacy, not that you're going to invest in just anything. If you're going to invest in just anything, are you going to invest in guns? No, no, no. Okay, so tell me what you don't invest first. So what you don't want that doesn't align with your values, and then we can move. We can function that around. And like again, the book is Investing Legacy: How the 0.001% invest. And then we have investors who care about access. Okay, what else do I get for my money? That's what sophisticated investors do. They want, and it's the same reason why people get involved in these deals is because it's sort of like buying sports teams. People buy sports teams so that you can tell other people behind your friend's back that the owner of the Pittsburgh Pirates or the Pittsburgh Steelers, New York Giants, whatever have you. That's what it is. And I think people today, they were like, well, I'm in these funds, I'm still paying fees, I'm not getting a lot of performance, but they want access. And families between 100 million and 1 billion generally do not have access if they're with an RIA. They have all their money in those funds, but they don't have access to the same direct investments, which provide I would consider a much wider, it outperforms because you're going direct by sheer fact that you're not paying additional fees for a fund to be able to do that. And also, there's also sophisticated waterfalls and other things that happen in these funds that a lot of people don't really understand unless you were to really read the documents and be a nerd like me. So, these are some of the concerns and issues that came up during the capital raising process here. Number one, we have one big family that he wants to walk into a structure he can't get out of. He says, I don't want to walk into a structure I can't get out of. 1031 exchange. Our solution to him was to close the transaction normally. We'll fund the construction loan as planned, and then we create a tick structure post-closing. It's low-cost, standard, and widely used across institutional real estate. So that's one of the things we had to come to. And the outcome is that the LP gets 1031 compatibility without complicating the initial transaction or disrupting the capital stack. Okay, perfect. Number two, discretion, the D word. I don't know what I'm going to say about this, but every time, and since moving to Miami, let me just make sure I'm not going on this. Yeah, here we go. All right, so these are two different things. You get a lot of guys who are like, yeah, I'd love to get into this investment. However, yeah, I got to talk to someone about. Who you have to talk about it? Your father. But you told me that you write the checks. No, my dad does. So now you have another layer on top of that. And there's a joke in the industry: the longer the hair of the second gen, the less legitimacy they have to have discretion in the deal. I'm not saying that. It's just a joke. It's not really. We have a lot of friends and investors who have invested in this, but you always have to remember that there's always going to be another layer, and you want to get direct to the decision maker fast and not without leaving it to them, because sometimes you can't trust people to their own devices. And if you have a gun to your head to close a deal in a short period of time. Another example of this is anything Elon Musk does. He does not care about your work-life balance whatsoever. So you just got to make sure that you communicate this with this. We had one issue where an investor came in. He was one of our favorite people, but he didn't have, he was investing, he or she, we'll just leave it at that, but I don't know if they're listening. But because of the trust and the limitations of the trust, and because of the internal politics between he and a family member, who is also a co-beneficiary of the trust, I would assume, he wasn't able to invest. And that caught us kind of flat-footed, because we had already put the documents together and everything at the last moment. It's like, no, it's not happening. And it seemed like it was a Mexican standoff. So that happens. You got to be careful of that, but you always have to make sure, I ask the hard questions, and some people get offended by it, but it spends a lot of time, but it also, again, frames the boundaries of the relationships with anyone that you're working with. Like, where's this money coming from? Who else do I need to talk to? Who else needs to hear about this awesome deal that we're working on right now? So, you got to ask those, because you got to have certainty in your mind for execution. You want certainty of execution. You want to make sure if there's anything, any weak spots, where's the weakest link in the chain, and how do we address that right now if we can? All right. And then the third one, it's interesting. So there's people who, and these are people who have money with with RIAs, J.P. Morgan, Raymond James, who Schwab, you name it. And they always like, oh, talk to my friend, talk to my wealth advisor, talk to my wealth advisor. Wealth advisors generally don't know unless they have a lot of money and they have access to the real estate department, and that works. But for the most part, a lot of these people, they rely on someone to do something that they will never do, and that is they're not going to sell away assets. They're not going to take money out of their pocket to give it away to a guy like me. It's just not going to happen. And the reason is because they make a percentage of the AUM. If you have $1 billion there, 2% per year, whatever the fees are for that, is a lot of money, right? So why would he even want to do that? And every time, and every time I tell myself I'm not going to do this, I'm like, okay, Jenny, I'll do this for you. And I talk to the RIA, and they don't like the deal, even though it has a star-studded operator lineup, and the cap table looks like it is something from, it's really incredible. They don't do it, and they'll make up a reason where, we Dallas, we don't like Dallas. All right, I don't know anyone who doesn't like Dallas real estate, but when you start hearing these phony answers for it, you don't want to challenge because a lot of these families are friends. But I'm just thinking to myself, yeah, I said, Jenny, I said, has this guy ever invested in anything that you wanted to bring? And I had a conversation with him. I'm like, you go to these conferences, you can't really tell people that you're going to invest in these things because they're just going to waste their time. And that's how you burn through relationships. If you have to constantly connect someone at another bank for them or your RIA to shoot it down, they're going to know that you don't have any discretion, and they're not going to be able to take you seriously. And that is something that really, burned me. And hold on one second. Yeah. So the RIA was breaking the investment. You got to understand too that not everybody, and when you learn the story and everything, you find out that she doesn't have the discretion her father does, and the father doesn't want to invest in any of this stuff. So, you find out that there's, internal family disputes, there's things going on, or they just want to keep it inside where it is right at that point. And that is something where, some unresolved family disputes can get into a problem here with that. Not every investor is blocked by economics or returns, and many are blocked by governance, as I'm telling you right here, egos, and dysfunctional structures that you will not be able to fix. So we moved on quickly and protected the raise from unnecessary delay as soon as this happened. As a capital raiser, you must recognize you cannot solve internal family politics. Don't even wait on it. Don't even stand there. Turn around. And these RIAs, I have a joke in the industry. It's like it's almost as inappropriate for them to ask them to part with their client's money as it is to ask them to sleep with their spouse. It's really what it is. It's never, ever going to go anywhere. Number 3, larger ticket sizes and direct participation. Some people were writing bigger checks, and what came of that was they wanted to go direct under the cap table. Sophisticated people. This is not just some guy with $1 million because he's not adding any value. But when you have the heft and names of families coming in, and you can tell other investors that's fine. If you go direct, that's fine. Why? There's a belief that they receive better economics by going direct. Of course, we wanted to put one line on the cap table, which was Brahmin Partners, but this family has their own line. There's also desire for greater visibility and influence, although that was not the case with this one investor. There's internal policies requiring direct LP positions, but and some families do this. They want to go direct rather than becoming an LP. And that really has to do with the function of the check size. You're not going to get that for 100 grand, million plus, depending on the total capitalization. This one was 5.2 million. So sure, that's fine. We can give them what they want. So, but this is also an investor that we have a long-standing, trusting relationship with, because this person also has investments into other entities of ours too as well. And the preference for fewer base layers between capital and operator. Again, she's getting direct access, or she's getting, not Jenny, but somebody I know is getting direct access to a deal. And the reason why they were able to do this is because they wanted to go direct, and the money always has a voice. All right, pretty cool here. All right, yeah, this is okay. I think we talked about this already. Larger ticket sizes, direct. Yeah, we just offered a direct allocation without disturbing the overall capital structure, which worked out very well. We made sure that we were Brahmin Partners was aligned throughout the sourcing initiatives and co-investment participation, and it maintained fairness so no LPC received terms that disadvantaged the group. Sometimes some people try to overcomplicate this. We don't, and it worked out very well. The outcome, larger checks, fewer LPs, and a faster closing. Families got the access they needed, and Brahmin and Creed kept full alignment across the raise here, which is amazing. So the deal economics, why it worked. If you guys want to know more about this, let me know. It's probably a good case study here. If you want to walk through the deal with me, I'll go through this. But it's what we like, smaller balance, Class A flex industrial. The reason is the returns, especially in areas of growth, are much higher, and risk, and I hate saying this, but comparatively speaking to a lot of real estate deals that have a lot of risk in it right now, there's not a lot of risk because the GP here had purchased this land and is contributing it at a basis purchase 7 years ago. Here it is, it's a 5.7 million raise. The IRR on this trended is around 29.1. The levered net IRR is 33, or maybe even a little higher. The multiple is 2.3x. It'll be stabilized in 2028 with a 1-year hold post-stabilization to season the rents, and then it'll be sold off to a REIT probably at that point. The IRRs brought people in. The credibility closed them, which is amazing. Okay, perfect. Bonus stacking. People want bonuses today. We've done this with many of our deals, especially life science deals. It's very difficult to get people's attention to do this, and we do this by doing bonus stacking. Our Basel appreciation dinner, we do this all the time. It's closed door. We bring in our CEOs. We bring in people who we're dealing with on SpaceX and people who we're dealing with on not just SpaceX, but Stripe and some other higher profile deals that we've been into, and ones that you haven't, but things that we've had some success with. For example, one of our portfolio companies receiving a $50 million investment from the largest sovereign wealth fund in the world. There's also priority allocation for future Creed pipelines. One line cap table for Creed. It is for us through Brahmin, but as I said before, we had larger ticket sizes, so there's probably 2 people on the cap table for that, which we're fine with. And Brahmin co-investment alongside LPs and other deals. One of the when you start doing this, I forgot I told you this. One of the things that a 21st century multifamily office does is they want to cross-pollinate and create intimacy amongst the families. There are people who are coming into this real estate deal, but they don't like Elon Musk, they don't like Stripe, they don't like anything, they just like real estate. Fine, okay. But what I'm doing is to sort of cross-pollinate them. I say, well, if you come in for $250,000, I happen to have an extra VIP ticket to the Stripe sessions that's happening in April in Palo Alto, and that's a pretty high-profile event. Mark Zuckerberg gave the opening keynote last year. He might do it this year. Who knows who it will be? But it's a star-studded event, sort of like the All-In conference that goes on. And I said, if you want to come and see where they'll probably maybe kind of sort of talk about their going public, and you want to share in that glory, come along. And a lot of people are like, you know what? That's a good idea. I will come. That's great. You got to make it good. And then, there's also like, there are going to be dinner parties at people's houses, and, people really want to get involved in it. What else are you going to give them for their money? I wrote a whole book on this. It's not a book, but a booklet. It's called what's the name? Calling the Capital. It's on Amazon. It is a little black book that you can probably get for, I think, maybe $5. And it talks about the case studies about how I was able to put money into these deals very quickly. And it's just what we call bonus stacking. All right. And then there's 2 final lessons here for the capital raisers. I want you to understand capital is a commodity. You have to trust the capital that is there. And lesson number 2, this is a new world we're in, post-pandemic, you must qualify LPs harder than they qualify you. You're marrying these people, all right? You're marrying these people. There are people who have come in and I've gotten some good referrals, and people have written some big checks just off of referrals from people, because that's, what happens when you have a good reputation and a track record. But I want to, people are making these introductions. I'm not going to send them docs. I got to know who these people are. Where the money coming from? Don't ask them. I can guess people's net worth on the phone. That's a trick that I have. I can guess exactly. I can tell you exactly what it looks like. And I talked to a guy. I said, he had an exit. And I'm like, you look like you're probably like a $40-50 million guy. He's like, yeah. I'm like, okay, that's fine. He's actually spoke at one of our conferences, closed door conferences here for a mastermind that we have. He actually invented a patent that Tesla uses for self-driving cars, and he sold it. Good for him. I am going to give you guys a free bonus here, because I think a lot of people are there's a lot more to this world than just multifamily. And if you're looking to allocate into different asset classes, meaning the four food groups, office, retail, industrial, and multifamily, then you might want to go to www.acpar.org. This is the same training I received at Goldman Sachs. It was reintroduced. I reintroduced it not too long ago for modern operators and capital raisers in 8 separate certifications. This certification is how emerging GPs and family office allocators learn the rules they should never break, and it's free. And I'm going to keep it up here, probably end it, at some point after Thanksgiving, but it's free, and you can hang those certifications on your WhatsApp and LinkedIn and Facebook, and I think Twitter too as well, which is great. And we set it up nicely for that. There are examples if you go to acpar.org, or if you go to Acpar on LinkedIn, you'll see pictures of people posting their certifications online. So that is perfect. We have books and resources. I'm finishing here. If you want to understand capital, operations, and legacy, you can grab all 3 of my books here by going to salvatorebuscemi.com. That's the only way you're going to get them autographed. Otherwise, you can get them off of Amazon. These are all on Audible, and the white one is my third one that I narrated myself. And that's specifically the blueprint for everything, that's really discussed here today. And then we also have a newsletter called The Art of the Raise. You can go to The Art of the Raise. I think it's a form right now. But this is really how to build trust with sophisticated LPs, the mistakes that kill deals before they start, the psychology of wealthy families, what's working now in private markets, direct deals, and co-investments, lessons from our own allocators across real estate, life sciences, and deep tech, the things that we're working on. You'll be able to look over our shoulder. And if you're a capital raiser who wants to level up, or a future operator who wants to avoid the mistakes that cost people literally millions of dollars, not to mention sleepless nights and credit and divorce, you need to be reading this. You want to go to theartoftheraise.com, get in the room, stay in the flow. This has been amazing. I think we ended here. Ladies and gentlemen, thank you so much for your time. I apologize last time that I was not able to provide for you, this comprehensive. I had some issues with a new laptop and a new place that I moved to where I had some really unstable Wi-Fi, but I do appreciate you being here. I hope you learned something. If you do see anything, or you have any questions, feel free to drop me a line. I'll be here for you. But this is really cool, and I appreciate. This is really, really interesting, and I'm very happy to be here. So that's sort of the case study of what we're working on right now. I am also going to be using this because there's a lot of moving parts here as it relates to the deal, and I think just looking at the numbers itself is one thing, but dealing with idiosyncrasies of the investors and working with them is a whole other opportunity. It's a whole other thing. But anyway, I really appreciate this. I really appreciate you for being here, and you guys are amazing. And stay tuned, because we're probably going to have something like this next Friday, depending on the feedback here. Thank you so much, guys. I'll talk to you soon.